It is Thursday morning, June 4th, 2026, and if you were looking at the overnight session, that historic 9-day S&P 500 winning streak is officially dead. The bell hasn't even rung yet, but the implied open is looking incredibly ugly. We've got S&P futures sliding after closing down 0.74% yesterday at 7,553.68. Nasdaq futures slipped 0.89%, and the pre-market volume shows massive capital fleeing the hyper-bullish AI trade.
Right, the mechanical gears of the economy are violently shifting this morning. The surface sentiment might have looked neutral yesterday, but, beneath that, institutional capital is aggressively repositioning.
Oh, they are hitting the exits.
Exactly. We are looking at a collision of cooling growth, severe geopolitical crosswinds, and a total repricing of risk. If you are just holding tech right now without watching the macro pressures, you're flying without instruments.
So let's look at the actual pre-market gappers, because there is absolute blood in the water. Broadcom, ticker AVGO, is tumbling roughly 12% right now, bouncing between $413 and $427. And, they posted $22.19 billion in revenue. They only missed the $22.27 billion consensus by a rounding error.
It's a microscopic miss, yeah.
Right. So how does a company essentially meet estimates and immediately lose 12% of its value?
Because of severe valuation exhaustion. For the last 9 days, traders haven't been buying Broadcom for today's earnings. They've been buying this assumption of infinite exponential AI growth.
A perfection price.
Exactly. Look at the S&P Shiller-GP ratio. It's sitting at historic extremes. In an environment priced for absolute perfection, an AI forecast that is just good is fundamentally unacceptable. The market demands transcendence right now.
But the real risk here is where the algorithmic traps are set for today. If retail dip buyers look at a 12% haircut and decide to jump in, what is the exact line in the sand they need to watch?
They'll be fighting massive institutional momentum. We need to see an immediate gap fill attempt pushing AVGO back toward the $450 bull case level. But, and this is crucial, there is a psychological floor at $400.
If 400 breaks.
If it takes a clean break below 400, algorithmic stop-outs trigger. Institutional risk models will auto-liquidate, dragging the stock down to structural support at $380.
And Broadcom isn't the only one getting taken to the woodshed. Look at CrowdStrike, ticker CRWD, down about 10% pre-market, sitting near $663.80. This one completely breaks the retail playbook. They beat Q1 top and bottom line estimates.
Right.
They even announced a highly anticipated 4-for-1 stock split. Usually, retail traders buy that up in a frenzy, but Q2 guidance was just a bit lackluster, and the stock is getting crushed.
The stock split is just a structural distraction. It cuts the same pie into smaller slices, What you're seeing in CrowdStrike today is a textbook bull trap. Late-stage bulls are getting flushed out by institutional profit-taking because we are entering a multiple contraction.
A multiple contraction, meaning the market just straight up refuses to pay a massive premium for future earnings anymore.
That's the exact mechanism. Investors suddenly don't want to pay 50 times revenue. They only want to pay 40 times. So the price collapses even if the core business is fine. If institutional selling slices through $650 today, a trap door opens. We'd see a rapid cascade down to $600.
Which brings us to the indices. If AVGO and CRWD are dragging the tape, give us the critical levels.
Yeah.
What is the line in the sand for the S&P 500 June futures today?
For the S&P, the absolute critical support zone is tight. It's between 7,540 and 7,535. That was the previous all-time high pivot, meaning there's a massive concentration of historical buying there.
So bulls have to defend 7,535.
They absolutely must. If 7,530 breaks, algorithms target a secondary liquidity pocket down at 7,515 to 7,505. And if that floor falls out, we drop to a deep value baseline at 7,445.
What about Nasdaq-100 Futures? With tech bleeding, it's got to be precarious.
The primary defensive line for intraday longs is 30,310 down to 30,270. But the real danger zone, the ultimate macro floor, is 30,000.
The big round number.
Right. If it breaks below 29,850, it completely invalidates the near-term bullish structure. Treat any morning bounces with extreme skepticism.
So why the sudden lack of forgiveness? To understand why a tiny revenue miss triggers a 12% collapse, you have to look at the cost of money. The 10-year Treasury yield is sitting at a highly restrictive 4.48% right now. Yesterday, we saw a 4.6 basis point surge, which is massive, the largest single-day jump since mid-May. And the U.S. dollar index, the DXY, is hovering at 99.45.
This is the invisible gravity pulling down the tech sector. The yield and the dollar are a double-barreled headwind.
But break down the actual mechanics for us. Why does a 4.48% government yield mechanically crush a profitable tech stock?
It comes down to the discount rate. When you buy high-growth tech, you are paying a premium for cash flows 5–10 years from now. But a dollar in 2036 isn't worth the same as a dollar today.
Right.
Analysts discount those future dollars backwards using a risk-free rate, which is benchmarked to that 10-year Treasury yield.
So it's opportunity cost. If I get a guaranteed 4.48% from the government, I need a much higher return from a risky AI stock.
Yeah.
And since the future cash flow hasn't changed, the stock price has to drop today to make the math work.
Exactly. That mechanical pressure violently compresses the multiple you're willing to pay.
Okay, but what about the DXY at 99.45? Apple, Microsoft, Broadcom, they're American. Shouldn't a strong domestic currency be good for them?
It actually hurts them because they're multinational. A strong dollar eats foreign earnings for breakfast. They generate massive revenue in euros and yen, but they report to Wall Street in dollars.
So when they convert it back,
The foreign currency buys significantly fewer dollars. It acts as an invisible tax on their global revenue.
and the catalyst for all this is the economic data refusing to cool. Yesterday's ADP private sector payrolls report had 122,000 jobs, highest since January 2025, plus rising JOLTS job openings.
Which is why retail is currently caught in the pain trade. They are trapped in a 2024 playbook, heavily buying long-duration bond ETFs and tech, blindly hoping the Fed will declare victory and cut rates.
But the real risk here is the money markets have completely flipped the board. They are now pricing in an 85% probability of a quarter-point Fed rate hike by year-end.
Up from just 60% last week. If tomorrow's non-farm payrolls print comes in hot, that 10-year yield is charging toward its 52-week high of 4.67%. Retail is holding the bag, while institutions shelter in short-duration cash equivalents yielding around 3.7%.
But they aren't just in cash. The pre-market flow maps show a massive capital rotation. Money flowing out of CrowdStrike is going straight into energy.
Energy is the undisputed safe haven right now, flanked by consumer staples and healthcare, a textbook defensive rotation.
And it's driven by geopolitics. We've got stalled U.S.-Iran ceasefire talks, strikes around the Strait of Hormuz. Even with the fragile Israel-Lebanon agreement, Brent crude is sticky at $97.16 a barrel. But let me push back on this.
Sure.
The OECD pegs 2026 U.S. GDP growth at a sluggish 2.0%. Slower economy means less demand. Less demand usually cools inflation. So how do we have cooling growth, but rate hikes and money flooding into energy?
Because we are looking at a textbook supply-side shock. Yes, 2.0% growth cools consumer demand, but Middle East tensions create a structural floor under the actual supply of oil.
So it's cost-push inflation, not demand pull. It's the structural cost of energy required to manufacture everything.
Exactly. And that makes energy cash flow models incredibly attractive. Because of that supply shock, energy companies are generating massive free cash flow. If an AI company misses guidance, well, the world still has to buy oil.
It's a low-beta, high-yield inflation proxy. Okay, so we're tracking the bond market pressure, the AI multiple contraction, and the energy rotation. But today also brings a massive, idiosyncratic wildcard, a fundamental regime shift for traders.
The death of the $25,000 pattern day trader rule.
The PDT rule is officially gone today, replaced by a real-time intraday margin system. For years, if you had under 25K, you were capped at 3-day trades a week. It trapped people in losing positions overnight.
It was incredibly punitive. But as of this morning, your buying power dynamically adjusts tick by tick.
So if a position goes green, you can leverage that equity instantly. But if it goes red,
The broker's algorithms will liquidate you instantly to protect themselves. It removes the handcuffs, injecting massive intraday liquidity, but also brutal intraday volatility. Retail can finally hit the sell button the second a trade turns. We're going to see some wild gap and go setups today.
and the absolute battleground for that newly unleashed volatility is Lululemon, ticker LULU. Earnings after the bell. It's flat around $125.95 pre-market, but the options chain is pricing in a violent 12% implied move.
Options market makers are hedging heavily. The math dictates a massive swing by tomorrow.
They're expecting EPS of $1.67 to $1.68, but that represents a 35% year-over-year profit decline.
LULU is a microcosm of the whole market right now. Premium brand, sluggish domestic demand. They're being forced into heavy promotional discounting to move inventory.
Which is toxic for a premium brand. The second you see a 40% off rack, the brand equity erodes. So what are the algorithmic levels on this 12% implied move?
Bull case is $145. If international growth beats and margins stabilize, we could see a brutal short squeeze. but the bear case level is 110.
That's a steep drop.
It is. If domestic demand is dead and discounting compresses margins, it'll slice right through its $120 floor. Below that, there's almost zero historical buying. It'll plunge straight to 110.
But the real risk here, the thing that makes this entire morning completely mind-bending, we have tech bleeding, a 4.48% yield, retail-facing rate hikes. And right in the middle of this macro reality check, we get the amended SpaceX IPO prospectus.
The ultimate wild card, dropping at the absolute worst or best time, depending on how you look at it.
SpaceX is officially targeting a $75 billion IPO this month, a $1.77 trillion valuation. You could make Elon Musk a trillionaire, but doing the largest debut in stock market history while the tech market is suffering a liquidity trap.
It creates a massive gravitational pull. When SpaceX needs $75 billion in cash, that money doesn't magically appear. Portfolio managers have to reallocate. They have to dump Apple, NVIDIA, Broadcom, just to make room for a $2 trillion mammoth in their benchmark weightings.
So, putting it all together for you before the bell rings. Respect the bond market. That 4.48% yield changes the math on everything. Recognize the AI valuation exhaustion. Watch the rotation into $97 crude and adapt to the new intraday margin rules today.
But the real question you have to ask yourself is about that liquidity. Retail is tapped out, facing a rate hike. Institutions are hiding in cash and energy.
So where does the $75 billion for SpaceX come from?
Exactly. Could this massive debut act like a vacuum, draining so much liquidity that it actively accelerates the broader tech correction we are seeing this morning?
It's a $75 billion vacuum turning on right as the market gasps for air. Keep your eyes on the yields, watch those support levels at the open, and do not blindly trust the old playbook. We'll see you on the other side of the bell.